welcome to Sectors Up Close. I'm Elena Casas. Today we're talking real estate investment trusts, and my guest is Randy Watts, CIO of O'Neill Global Advisors. Home sales in the US have slipped back in recent months. In the latest sign, a slowdown may be underway in the housing market as the Fed rate pushes mortgage rates up and house prices are up more than 10% year on year. An increasing number of Americans are priced out of buying a home and rents are spiking nationwide. That is not necessarily good news for the residential real estate investment sector, though. After the first 8 months of the year, student housing and casinos were the only property types in the black year to date. This is the SPDR Real Estate Sector ETF, down 25% year to date. It's dragging behind the wider market. Well, will the sector build better future returns? Let's ask Andy Watts, CIO of O'Neill Global Advisors. Randy, hi, thanks for joining us. How is this sector positioned to deal with rate rises to come?
Normally, REITs do pretty well when the market declines because they're a relatively defensive group and their earnings are relatively stable. However, this time around, rates are rising at such a rapid rate and are making such a big move that it's really pressuring REITs. To put in perspective, the average REIT in the United States has a dividend yield of 3.4%. As we look at where rates are moving today, the 2-year and the 10-year are actually above that. So that is causing a lot of pressure on REITs. In addition, REIT dividends are actually taxable. They're taxable as ordinary income, not as dividend income. And because of that, I think a lot of retail investors are starting to look to fixed income instruments to generate income as opposed to REIT dividends. So the group's been under a lot of pressure. And as you mentioned, REITs have actually underperformed the S&P year to date.
There is a defensive aspect, though, isn't there? Because ultimately you're paying into an asset that will appreciate in value generally. So do you think that the REIT situation will improve as the economy declines?
I think REIT earnings are going to be more stable than overall S&P earnings if we move into a deeper recession. You know, one area we like particularly, like you mentioned earlier, is apartment REITs. The move up in mortgage rates, if you look at U.S. mortgage rates, they basically doubled since the beginning of the year. That means that many Americans are being priced out of buying a home and they're forced to rent. So apartment rents in the U.S. have been rising pretty rapidly and occupancy rates are very high. So we think REITs in the apartment sector are going to hold up better than maybe the overall REIT sector. We also like healthcare, companies like Omega Healthcare, where they're either doing long-term care facilities or hospitals, and those are also very stable in terms of their overall revenue mix. But again, we think the sector is going to be under pressure until rates start to stabilize, because right now bond rates are above REIT dividend yields.
If that's where you see the bright spots, then which part of the REITs market are definitely to avoid?
I think some of the areas that are likely to be under pressure are office REITs. Office REITs have very long-term lease structures. So as rates and inflation move up, they can't readjust their rents quickly. And that's been one of the weaker areas. Interestingly, REITs that operate in the technology space, particularly in terms of hosting, have actually been very weak stocks. Stocks like Digital Realty Trust and Equinix, those have been very poor performers. So we don't really see any stabilization there yet either. We're really trying to focus on REITs where their lease structure is shorter in nature so they can adjust for this higher inflation.
How should investors be approaching REITs then? With extreme caution?
I think right now it's good to be cautious until you believe the rate cycle is stabilized, but there is going to be an attractive time to buy them. I would hope over the next year, once it looks like the rate outlook is stable and interest rates have pretty much stopped rising. I think then these stocks can perform very well. They do very well in a declining interest rate environment because of their stable dividend yields.
Well, thanks so much for that insight, Randy Watts, CIO of O'Neill Global Advisors. And that's it for our look at real estate investment trusts. I'm Elena Casas, and this is Reuters.